Okay, well, we have previously discussed that this is a company and this is a company, and this company is owned by shareholders and run by board of directors. So here two relationships built between the shareholders and the board of directors. The first relationship that we call agency relationship. In this relationship, the shareholder acts as in principal, while the board of directors act as an agents. So mean the agent perform contracts and other activity on behalf of the principal. This is the first relationship. The second relationship about which I have told you that is called stewardship. In stewardship, the shareholder provides the properties and the asset to share to the board of directors, and board of directors actually utilizing those assets, and at the end they are accountable for their actions. So means the board of directors act as a steward, okay, and the relation we call it stewardship. Now when the director or in the board of directors acting as a steward, for that purpose they have to prepare some statement that we call financial statement. And these financial statements are prepared for shareholders. Okay, now these shareholders want independent review of financial statement. And why they need independent review? Because they have incentives for the board of directors, and the board of directors may manipulate the result. So for that purpose they need independent reviews, and for that independent reviews they hire a person that are called auditor, which are independent, okay, which are knowledgeable, okay, which are third party, which are impartial, and these auditors audit the financial statement, and at the end they give opinion that whether the financial statement give true or fair view. Okay, this is the concept we have already discussed. We have also discussed that if the audit of the financial statement, if the audit of financial statement are required by law, then we call that statutory audit. Okay, and if it is not required by law, and if someone doing it voluntarily, then why they are doing this? Because there are some benefits of the audits. Let me write for you guys the benefits. What are the benefits of the audit? So the first benefit, if you see, it will increase the reliability of the account goes up. Okay, the other benefit is give comfort to whom? To stakeholders and sleeping partners. Okay, give compile to, and then they also system check, management, get expert opinion on system. Then you can also say that the audit of the financial statement give a moral check on employee. So these are actually the benefits, and that is why the people or the company want audit of the financial statement. We have already discussed this in the previous lecture, and in the today lecture we will look at the level of assurance. And I told you before that assurance is actually the satisfaction. Okay, and there we have two type of assurance. The one is called reasonable assurance, and the second one is limited assurance. Okay, and this means that we don't have absolute assurance. Okay, the reasonable assurance means that less than 100%. Okay, and absolute assurance means we 100% guarantee. So in audit there is no 100% guarantee at all. Okay, if we check here, let me write here. This is in reasonable assurance. What is the thing going on? The practitioners, okay, the practitioner gathers sufficient and appropriate evidences, and on that basis to conclude that the subject matter, which is in the case of the company is a financial statement, agrees with the set criteria. Okay, this is in the reasonable case. And other thing in the reasonable assurance that it will give the positive assurance. This means the positive assurance, which means that that in their opinion, and mean that in auditor opinion, that the financial statement has been prepared in accordance with the criteria required. Okay, and this is the detailed procedure, means we are doing TOC, that is called test of control, and we also do some substantive procedures, and we will discuss this in the later chapter, that what is TOC and what is substantive procedure. And the example for this is the audit. External audit is the example of reasonable assurance. Okay, now if you see, on the other hand, we have limited assurance. And limited assurance, what we do, we only necessary to gather enough evidences to be satisfy that the financial statement or the subject matter is valid, plausible, valid in the circumstances. Okay, and here the auditor will give negative assurance, and the negative assurance means that nothing has come to the attention that suggests that the subject matter financial statement or not prepared in accordance with the applicable financial reporting framework. And you can also say that the example for this is review engagement. Okay, example for this is review engagement. And the negative assurance, the satisfaction that is nothing suggests the subject matter is not prepared in alignment with the learning criteria. So and if this is not audit, okay, review engagement is not audit, and this should not shared with the shareholders. Okay, this is just a review, and we will share this to the body commission the review like banks, the directors. So this is the thing we have to understand. And then we have also to discuss some objective of the auditors. What is the objective of the auditors? So an auditor that obtain reasonable assurance. This is the objective of the auditors. The second objective is to express opinion. They have to express opinion on the financial statement, and then report on the financial statement. This is usually the objective auditors, and I told you before that why we need audit. So for that we have discussed that there are some benefits of audit, and we have also discussed limitation. Okay, no, we have not discussed the limitation. We will discuss this. What is the limitation of audits? And then we will discuss expectation gap. That what is expectation gap? Clear? So let me move on to the here. Okay. So assurance. I told you that types of assuring engagement, we have two types. One is reasonable and one is limited. Okay. And reasonable assurance, the practitioners, mean the auditors, gather sufficient appropriate evidence that able to draw a reasonable conclusion, and they conclude that okay, the subject matters conform in all material respect with identified suitable criteria, and they give the positively worded assurance opinion, and give high level of assurance. It's a high level of confidence they give. And if perform thorough procedure means they perform a very detailed procedure like test of control and substantive procedure. And what is the opinion? How they state in the opinion? In the opinion they state that the financial statement give true and fair view in all material respect and the financial position of this company and its financial performance and its cash flow for in accordance with the international financial reporting standard. On the other hand, as you see that that the practitioner will give sufficient appropriate evidence to be able to draw a limited conclusion, and then they conclude that okay, the subject matter with respect to identifiable suitable criteria is plausible, mean valid in the circumstances. They give negatively worded assurance, and this is a moderate or low level of assurance. And they perform pure procedures, mean mainly inquiries and analytical procedure. They are not doing QC or some substantive procedure. Okay, and what they actually write, they write in a statement, an opinion that nothing has come to our attention that causes to us to believe that financial statement of this company is not prepared in all material respect in accordance with the financial reporting framework. So this is the actually the words and opinion they give, and we have discussed this in detail. Now, the objective of the reasonable assurance is actually to reduce assurance remain risk of acceptability when they reduction in assurance engagement risk to acceptably low level is circumstance again, and this is the basis of the for assurance practitioners. The conclusion is usually expressed in positive form. We have discussed this. In order to give a reasonable, a significant amount of testing and evaluation is required to support me this required a detailed procedure, and in detailed procedure we do some QC and we also do some substantive procedure. An external audit is an example of the reasonable assurance. Okay, the purpose of external audit engagement, let me discuss this with you guys. That the purpose of the external is enhance the degree of competence of the intended user, which or the stakeholder or the shareholder, and the financial statement. And this is achieved by expressing opinion about the financial statement give truth and fair. And about truth, I told you that it means that the thing is actually which is expressed or present in the financial statement is actually present, and fair means is unbiased. Okay, so mean present fairly in all material respect and appropriate in all material respect in accordance with applicable financial reporting. And true and fair, true mean factually correct information which conforms with the accounting standard and relevant legislation and agree with underlying regard. The financial statement have been correctly extracted means the accounts are accurate and they have extracted it accurate from the books and records. So this is the thing we have. An objective auditor, we have discussed that the first objective is obtain a reasonable assurance about whether the financial statement hold are free from material misstatement, whether due to fraud or error. This is the first objective of the auditor. The second, they have to express an opinion and the financial statement that they are prepared in the material respect and all materials will be financial reporting framework. And the third thing is that reports on the financial statement and communicate is required by ISA in accordance with the auditor findings. This is the objective of audit. Now, why we need audit? Why we need audit? I have told you before that I know the board of directors prepare the financial statement, and these are for the shareholder, and the shareholder actually wants the independent review. And why they need independent? Because the directors have various incentives to manipulate the financial statement. So for that purpose, they hire independent person, and that is the auditor. And the auditor will give the opinion on that financial statement. Okay, if the company is required by law to prepare the financial statement to perform the audit, then that we call a statutory audit. If it's not required by law, then they do the audit, and that audit because of the benefit of the audit, and we have discussed the benefit of the audit in very detail. And here you can also see that higher quality information which is more reliable, improving the reputation of the market. Mean when the information you audit, it become high quality and it's more reliable and it improve in the reputation of the market. The second thing is, independent scrutiny and verification may variable to management, give expert opinion to the management of the system, and reduce the risk of management bias. I mean, there may be a collusion between the management the management implies. So it will also reduce the risk of management bias, fraud and errors, acting as a, so the audit may also detect bias and fraud. Now, enhance credibility of financial statement has also enhanced the credibility of the financial statement, because when the financial statement have been audited, so the tax authority will rely more on that, or you can say that the lender will also rely on those financial statements, and in contrast to those which are not audited. And the deficiency in the internal control system may be highlighted. This is the system check. Okay, and for limitation, and there's a lot of limitation, but here we have, there may be a human error may occur. There is a lot of uncertainty. Okay, and there are some other thing like collusion of the auditors and management. So financial statement includes subjective estimates and other judgmental matter like useful life. We estimate the useful life. We also estimate the scrap value. So there are a lot of estimate, and that basis this is the limitation of the audit. There's a internal control may be rely on which their own inherent limitation mean the auditor have to rely on the internal control, and internal control is there are some inherent limitation because the management is involved in that. Representation from management may have to be relied on only source of evidence in some cases. Sometimes you need the representation of the management, and the management will not give you a statement that is against them. So this is the limitation of audit. Evidence is often persuasive, not conclusive, and this also means that the evidence sometimes is okay. That will not be convincing, but it's okay for time being. Says okay, but it's not convincing. And the other thing that we do sampling in auditing, we not test all the transaction. So auditor tests on sampling basis. So these are actually the limitation of the audit. Now, audit provide reasonable assurance, which is not absolute assurance, and the limits of the audits mean that it's not possible for 100% limitation. Expectation gap means that the auditor, let me take from the example here. I believe that auditor tests all transactions, and this is not the case. The people think that okay, the auditor tests all the transactions, but auditor work on sampling basis. So this is the gap between what the audience or what the people thinking about the auditors. I believe that auditor required to detect all fraud, and the people think that the auditor will detect all fraud, but that's not the case. Auditors are required to provide a reasonable assurance that a financial statement or free from material statement, which may be caused by fraud. I believe that auditors are responsible for preparing financial statement, which is not a work of preparing the financial statement, not a work of auditor. This is the work of management. So these are the gap between the people and the auditor. So the people expect that the auditor will test all the transactions, but not the case. So some user incorrectly believe that audit provide absolute assurance, and this is not the case. They provide reasonable assurance. The audit opinion is a guarantee that financial statements are correct, and this is not the case. This is other misconception about the role of the auditor and refer to expectation. Again, this type of expectation, we get expectation gap. Limited assurance, we have discussed this in a very detail. There's a lower level of assurance. The nature, timing, the extent of the procedure carried out by the practitioner is limited assurance, limited compared to that of the audit and reasonable assurance. And procedure for firm should be planned to obtain a level of assurance which is meaningful in the practitioner professional judgment. And a review engagement as the limited assurance example. The purpose and objective of review engagement. The word is the purpose of review engagement. So the company which is not legally required to have audit choose to have a review of their financial statement instead, and the review will still provide some assurance to user, but it's likely cost less and less destructive than audit. This means Then when you are not legally required to do the audit, some user want to take review of their financial statement, and this review provide assurance to the user, and this is a less costly and less disruptive than audit. Or the procedure will mainly focus analytical procedure and inquiries, mean they are not focusing on QC or substantive procedure. They are only focusing on analytical procedure and inquiry. We will discuss this in the upcoming lecture. And no test of okay is fine. Now, as only limited assurance is being expressed, the work does not need to be in-depth. I mean, we don't do a detailed work. We just a surface work. The objective review of the financial statements enable the auditor to state on the basis of the procedure which do not provide all the evidence required audit. Anything has come to the auditor attention that causes the auditor to believe the financial statement or not prepare any cut. So this is actually the objective of the review of the financial statement. Now the objective review is to obtain a limited assurance, and we know that and this is the example of the unlimited assurance engagement. So the objective of the review engagement to obtain a limited assurance about the subject matter with the financial statement is pre-for material statement. So the major outcome for the recipient reception of the review engagement, recipient of the engagement, is that the level of assurance they gain from is not high with respect from the audit, although this procedure carried out in a review engagement or similar to the audit. Okay. Then we have types of review, and we have two types of review. The first one is attestation engagement, and the second is direct engagement. And the difference between these two review engagement is that who is measuring and evaluating the underlying subject matter. In case of attestation engagement, the auditor is the practitioner, mean the auditors has not been measured or evaluated by the practitioner, and the practitioner concludes whether or not the subject matter information is pre-programmed. Mean in this case the subject matter is not measured or evaluated by the practitioner, and practitioner just conclude whether the subject matter information is pre-for material statement. An example is here. If you see a good example, let's say a review of sustainability report. If there is a review of sustainability report which has been prepared by management, is not prepared by practitioner, and prepared by management. In this case, the management measure and evaluate the extent to which the company has achieved its sustainability target. Okay, this is the evaluation and measurement as done by the management, and this is called attestation engagement example. In this case, the practitioner provides conclusion as to whether the measurement and evaluation is free from material misstatement. Means that measurement and evaluation is done by the practitioner, and the auditor will check and will conclude that whether there is measured and evaluated as free from material misstatement. On the other hand, we have direct engagement, and direct engagement where the underlying subject matter has been measured and evaluated by the practitioner. Mean practitioner doing all these two things, measure and evaluate, and then practitioner then present the conclusion on the reported outcomes and the assurance reports. And the example for this is when the practitioner is engaged in carried out review of the effectiveness of the company's system of internal controls. The practitioner would evaluate internal controls, then issue assurance report explaining the outcome of the review. So this is the two types of the review engagement. Let's do round up of the chapter. We have done the external audit. And what is external audit? In external audit, I told you that the type of assurance engagement is carried out by the auditor to give independent opinion on a set of financial statement. Then audit provide assurance to the shareholder and other stakeholder of the company of financial statement because of independent and impartial. Assurance services include range of assignment from external audit to review engagement, and then we have discussed the types of review engagement. Then internal auditors are implied internal part of the organization system control, and the responsibility are determined by management and may be wide-ranging. The auditor's report on the company financial statement is expressed in terms of truth and fairness, and these are we have discussed auditing. External audit give a reasonable assurance that financial statement are free from material statement, and the degree of assurance given by the impartial professional will depend on the nature and engagement being performed. So this is the chapter number 1 we have just finished, and in upcoming lecture we will discuss the next lecture. Okay, thank you for